Ready for a high detailed video including stock picks, the potential for a recession coming, and catalysts, as well as where the heck was Kevin yesterday? Watch this video. But remember, the gold course has a big price change coming up at New Year's Eve. So if you want a tax deduction from somebody investing and managing over $100 million, that's me. Go to meetkevin.com or click the link down below. Check out the gold course. I'll teach you how not to pay taxes in America, how to build wealth on investing in stocks, investing in real estate, entrepreneurship, productivity, just real data and facts on building your wealth. Go learn it all in the gold course. Comes with lifetime access. New lectures are dropping tomorrow, and you get lifetime access to the course member live streams. Let's get into the update. Well, what the heck happened yesterday? And we've got a lot to talk about in this video, from catalysts coming up, my stock picks for 2024. I'm going to break those down in this video. Recession coming as predicted by manufacturing. And I'll also explain not just what happened in the stock market yesterday, but quite frankly, where the heck was Kevin yesterday? Yeah, I know. Yesterday, it's like, went back to doing market open live streams, and for the first time since we've come back, I didn't do one yesterday. I posted a little heads up that I wasn't going to, and I apologize for that. I feel bad about that. Here's what happened to me really quickly. End of the year audit prep. Okay, we get audited, not tax-wise. It's like for househack, having a startup when you raise money, and I got to get everything perfect. I was up to like 3 or 4 in the morning, and then I decided, okay, I could get an hour or 2 of sleep and ruin the day, or I could unfortunately not do the live streams and spent some awesome time with Mr. Max, which I was so fortunate to be able to do. I did take that day to spend time with family, so I apologize for not being there. Now we'll talk about what happened in the stock market as well. I'll also explain why I was in Utah in the first place. It wasn't actually to go skiing. It was actually to meet a seller of a $16 million deal not necessarily actually in Utah. But I went there because we were negotiating a deal and I wanted to close the deal. So I decided, you know what? Easiest way to close the deal, in my opinion, is with somebody in person. I love closing deals. This is, by the way, Max learning how to ski and then Max being dead after skiing. He was so tired. But anyway, yeah, I'm a big person-to-person believer. We've got a ton of great interviews lined up for the channel in 2024. 2024 is going to be sick. We have such great foundation set, but this is just advice for everybody. If you're having trouble closing a deal, and you're frustrated, somebody doesn't understand a POV or what's going on, sometimes it's a matter of meeting people in person so you can understand the emotion, the sincerity, and the reactions you're getting from things you're saying. It's really amazing. If you're in person with somebody and you say something, you might not realize on the phone or text or email, certainly not in those last few, that something you're saying actually rubs them the wrong way. Whereas when you're in person, you could figure out why somebody feels a certain way and structure a deal. So househack got a $16 million deal that we think we got for like $2 or $3 million below value. Sick deal. Multifamily, by the way. All the details over at househackhomes.com, the Househack YouTube channel if you want to see it. Because I was able to drop everything and fly over there the next day and finalize the deal. And we're at negotiations. I'm like tired of this back and forth. I'm like, hey, can I just talk to the seller directly? And the agent's like, yeah, this is abnormal, but sure. How do you want to do it? I'll meet them. Where are they? Done. I'm there. It's powerful. Anyway, so again, those updates over at the Househack Homes YouTube channel. I'll link it down below in the top of the description. So that's why I wasn't there yesterday. So I had to negotiate a deal. Then I had to do a ton of auditing work. Some of the staff's out of the office. And then I thought, do I want to be dead tired for helping Max learn how to ski? Or do I want to take the holidays here and spend some time with Max and Jack? That's what I decided to do. So longer explanation, but a little bit of an update. It sets for good foundations for 2024. Okay, so what happened in the stock market, though, yesterday while I was gone? Well, my take, 2 things happened. Number 1, we didn't get the breakouts, okay? We actually had like failed breakouts. In fact, Tesla is the perfect example of a failed breakout that we had here. I mentioned in the Thursday Market Open live stream that we really need a full candlestick above 258 to be able to confirm a breakout on Tesla. The second it became apparent we weren't going to get a full candlestick above 258, this sucker dropped. I mean, it went straight to 248, not a surprise. See, when we closed at 263 or whatever, on the average candlesticks, you could see that's like a tiny little nub above that critical threshold right there. That's not good enough for confirmation. You can't rely on the 1 minute candlesticks to assume that you've got confirmation. So of course, when that died, that was over for Tesla. You could see that pain. See how we were briefly over here in that 260s. Boom. Once we failed, we broke right through. Very, very critical intersection here. Now, not only did we have failed breakouts at things like Tesla or Nvidia trying to get over 500, couldn't pull it off, or Apple to get over 200. Not only are we having these failed breakouts, but as the breakouts are failing, guess what happens? Two things. Number one, institutions start going, you know what? It's time to take some profits, because guess what, folks? And this is the misalignment of a lot of the mainstream finance world. They don't really care about necessarily what's 100% best for everybody. They want their bonuses. And that's okay. It's just the way the system's structured. Anybody who's watching who's getting a bonus on trading performance at the end of the year, good for you. Like, that's the system it is. But let's be real. If you got tendies on Tesla going into the end of the year because of some of the positioning you did in 2023, you want to realize those going into the end of the year. So that way, when the January review comes in and the boss comes in and goes, all right, how was everyone's performance? And how does that performance compare to the benchmarks, like the S&P 500? Well, then you get more of a bonus if you took some profits. If you lose all your gains going into the end of the year, like the last 2 days, well, your profits go down, which means your bonus goes down. So there's a lot of that, but there's also bragging rights. When you're a fund manager, you want to be able to brag. Oh yeah, we beat those ETFs and we beat that benchmark and we beat this and that. Whatever. Like, I run an actively managed ETF. I get it. I personally just don't care because I run an ETF for me. I think in the future, everybody should be able to have their own ETF because of the crazy tax benefits of an ETF. It's like 1031 exchanging stocks. Bro, imagine if you're a trader and you could do that. How sick that would be. Maybe one day. But anyway, even if you're a long run investor, just be freaking amazing to be able to 1031 stocks. It'd be crazy. So anyway, that's one reason. So failed breakouts and then this institutional profit taking to increase likely performance-based pay at the end of the year and bragging rights for institutionals. Those are really big reasons for the sell-off that we saw going into the end of the year. My take. I don't really think it was tax loss harvesting as much since 2023 was obviously a very good year. So what else? Well, now we've got to understand, okay, well, what's next? What about catalysts? I mean, that's what happened at the end of the trading days here. But what about catalysts going forward? And what about my stock picks going forward? We're going to hit my stock picks in just a moment, but I just want to remind you about some of these catalysts, which I'm telling you, I love eHack so much, eHack.com, because I went, just as I'm filming this video, I just went private browser, popped on over to eHack.com, scrolled down to my catalyst, and look, oh, there it is, and I can just reference it every day. It's going to be a busy week, on the 3rd, once we kind of all really actually get settled back into the office, we're going to get JOLTS, we're going to get FOMC, we're going to get ISM prices paid, okay, Institute for Supply Side Management, ADP report, jobs report. The next week we get CPI, core month over month, all the CPI numbers come up. Those are going to be pretty big catalysts. But another thing for you to keep in mind is what about the whole recessionary fear? So I wrote a bunch over here on eHack about what's going on with some commentary from HSBC, what's going on in Europe. But one of the big ones that I want to pay attention to is I keep hearing people talk about this fear, this uncertainty, this doubt that we're going to go into a recession because manufacturing is down. And so what I decided to do was, okay, well, let's go into history and see how many recessions have actually been driven by a manufacturing recession. And the reason I want to do that is I want to see, is it manufacturing that fails first, or is manufacturing reacting to a weak economy, right? So in other words, if we have weak manufacturing numbers now, does that mean we're going into a recession, or is it a sign of some other stress, right? So here is a summary of recessions going all the way back to 1937. You ready for this? 1937 recession was caused by fiscal debt, like a lack of fiscal debt growth. So in other words, the government actually being a little bit more responsible with its spending and fighting inflation. So what causes a recession then? The government and the Fed. Keep in mind what you have today. You have the Fed priming to lower rates and support the economy, and the government never stopped spending money. If anything, during this last cycle, they are why we didn't go into a recession. Like, and this is not to be political, I'm just saying, when you just spend money like crazy on the Inflation Reduction Act, the CHIPS Act, whatever. I mean, many of the other policies that were implemented as well, and loose interpretations of laws that were passed. This spending is supportive of GDP. We know that. Okay, so what else? So when you undo that, you might have a recession, right? 1945, massive cuts in government spending. Yep, massive cuts in government spending. Not good. That could drive you into a recession. Again, opposite today. And I'm not here to say this time is different. I'm here to tell you, when are things the same, and when do they rhyme, and when are they just straight up the opposite, right? 1948, post-war inflation due to pent-up savings and demand lead to an inflation blowout, going from 3.3% to 11.6%. Boy, that sounds familiar, I wrote. Mild recession after policy makers responded late. And that also sounds somewhat familiar, responding late, right? Okay, worth noting. Then you've got wind down of government spending. Remember, today we're actually seeing an uptick in government spending, exactly, and debt expansion. 1957 recession, Fed-induced tightening. 1960, U.S. diminished demand due to globalization. Basically, we're going to buy the Chinese stuff as opposed to the American stuff. 1969, debt, inflation, Fed. 73, oil embargo, inflation, Fed. 80, Fed and inflation. 82, Fed and inflation. 90, oil price shock, inflation. 01, dot-com bubble. 2007, real estate bubble. 2020, COVID. So what I wrote is, based on history, none of these are driven by manufacturing. None of them. Not a single one of them was led by manufacturing. The point of that is, yes, manufacturing responds to higher interest rates, to a weaker economy, a level of growth that is slowing. Yes, manufacturing responds to that, but did that cause a recession? No. It was always something else. Fighting inflation, the Fed being too tight, the government cutting spending. Now, is the government cutting spending or expected to cut spending in 2024? No. Is the Fed expected to loosen in 2024? Yes. Is it possible they don't loosen enough fast enough and we still have an over-tightening problem? Yes. Does that mean there's still a risk of a recession? Yes. Will it be driven by manufacturing? No. In fact, when I was done negotiating on that $16 million deal for househack, which remember, go to the househack YouTube channel to learn more about that, I met some JPM bankers and traders, actually. And I'm like, hey, what's your take on recession in 2024? And they're like, well, 50%. I'm like, oh, it's actually higher than I thought. What do you think the Fed's not going to cut? Like, do you think second wave of inflation? No second wave of inflation, just too much damage basically already done. So it's definitely still there. By the way, if you want to learn how I do all of these deals, whether it's entrepreneurship, it is building wealth through real estate, building wealth through stocks, understanding tax benefits, how to not pay taxes in America, and more, check out the Gold course. It's the first link down below. There is a massive price expiration coming in here at New Year's, so I really want you to consider checking that out. It is the best content I've ever created. It is all filmed, or was all filmed, and still is being filmed, at the end of 2023. So it's all Q4 content. Every single lecture in there is Q4 content. There's not a single piece of old stuff in there. I'm not saying the old stuff isn't good. I'm just saying it's adapted to now. So if you want to buy your first house, you want to buy a rental property, you want to minimize the taxes you pay, you want to be an entrepreneur, you want to set up LLCs, you want to learn about insurance, you want to learn about systems and procedures, checklists, efficiency, how do I get all done that I get done? Folks, the Gold course. It comes with lifetime access to the live streams. It is really, really good. And I think you'll love it. And I keep adding new content to it. I think sometimes that's what people forget, is that I don't just make the content and then leave it there forever. I add content to it. And the fact is, every single day we do a course member live stream, you get more content there as well. I've always said I'll stop doing the live streams for the course member live with like a 6-month notice or whatever. It's been 6 years of me saying that, and I'm like, I ain't going anywhere. They're so fun. I love the course member live streams, so I have no expectations of going anywhere with those. And you get lifetime access to not only the whole archive from 2018, 19, 20, 20, 21, 22, 23, everything, and the lectures going forward. It's insane. It's really, really, really good. So you get all of that in one course, the gold course. So check that out. Obviously, if you already have that, you want to bundle up, email us at staff@meetkevin.com. We'll take care of you here before New Year's Eve. So go ahead and do that. So, okay, that's good to know in terms of recession. But what other problems do we face? Well, one that keeps coming up is people are worried about this Cleveland Fed's NowCast for inflation, which currently sits at 0.33% for core month over month. Not great. But what I thought was really interesting is I just typed NowCast into X, Twitter, basically. That's too wide of a screenshot, so let's do it like that. And look at this. Everybody's been freaking out about NowCast for a while. Here's a NowCast estimate somebody posted from May 2023. I don't want to spoil the party, but we've moved from like the NowCast is estimating 43 basis points, which is an acceleration of core CPI. That was in May. That didn't end up happening. Cleveland Fed inflation report. This is the April 11th report. Oh no, it might be 45 basis points. Oh no. Here's another one. Oh, my nav kind of covered that one. Oh, there we go. Here's another one. Core CPI NowCast 0.38 in this whole thing from September 23rd complaining about the NowCast. Then you've got here's somebody using some of the NowCast data. You've got NowCast data here from and they were using this in May. Here's one in August talking about how high NowCast inflation is. Oh, could be a messy CPI read coming up because the NowCast is accelerating. That one's from July. End of March, NowCast sitting at 6.8%. Oh no. Checking the inflation, NowCast is not expecting the year-over-year CPI figure to move higher at its next reading, whatever. So the point is like, now. They wrote not, but now. They meant to say now, and that's 46 basis points. That was January of 2023. So the point is, I get emails like this, okay? And that's what motivated this. Do you ever check the inflation NowCast? It has CPI coming in at 3.3 for December. This is the highest it's been in 3 months. Could this spook markets? Blah, 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 blah. Whatever. And so I actually really appreciated this person sending me this email because it motivated me to just search a little bit at the history of the NowCast. I'm like, all right, I'm just not going to be worried about it. I'm going to wait until the CPI report and then compare that 3, 6, and 12-month trend to all of the other CPI reports and incorporate the fact that when we study earnings calls every single day in the course member live stream, there's no inflation left. Like, it's almost all deflating. Again, and I always say this, but I want to be clear, with the exception of ski resorts and aviation. Those two sectors have massive supply issues. There's not enough supply of ski lifts. You don't have enough, quite frankly, you don't have enough snow right now in America. 2023 took it all. Well, early 2023 took it all. It snowed until like May or July. How stupid was that? And then with aviation, oh my gosh, after COVID, the aviation industry exploded. Everybody wants a plane. It's crazy. And anyway, so okay, so now what? All right, well, so that's NowCast. Now we've talked manufacturing recessions. Now we've talked why we had a little bit of a weak end there. So what do we really have to worry about going into 2024? Well, probably the Fed not responding quickly enough to weakening jobs data. I'm really concerned that jobs data comes in too low and we end up creating a self-fulfilling recession. I actually just put out an email for basically applicants. I'll actually give you the terms that I put in it. And I want to be clear, like, I think I provide great benefits for employees. But I just ask that people, when they want to work for me, mostly, almost everyone, come work for me in person. Because we got to work together for startup. I can't do this like remote crap. It's almost like getting paid to not work. Come on, man. And I know that's not true for everybody, but I don't know. But anyway, so I put this post out. I said, send resume. Anyone know someone looking for a $250,000 a year software career with benefits and eventual stock comp? Fintech, hoping to go from tiny to multi-billion-dollar valuation, need one more. AI helps, but we can teach it. We're really looking for a full-stack dev capable of, coding with React. Must be in person, and we'll even pay to relocate you to Ventura, California. People here, it's funny. People are like, ew, Ventura, why would I ever move to California? California is a cesspool. I don't know, maybe Ventura is the best kept secret, or one of them, but Ventura's freaking awesome. And the people who move here, they're like, dude, I didn't know California was, like Ventura specifically, or parts of California, San Diego, Santa Barbara. These aren't secrets, right? Montecito, Palo Alto, San Luis Obispo. A lot of people are like, wow, I did not know California was this freaking amazing. There's a reason people pay the prices to live here. Orange County, Irvine, those are other examples. Chula Vista is up there. In there. Maybe not up there, but in there. Anyway. Okay, so, we're seeing applications for people. And so we're like, this is great. It either means we're offering a very desirable position, or is there a chance maybe more people need jobs now and there are less available jobs? I don't know. We'll see that with the JOLTS data, and then obviously the jobs data coming out this week. Those are going to be very, very important data sets. I can't understate how ridiculously stupid it is to argue for deflation. If you want deflation, you are arguing for depression. The Fed knows this. And you might say, but we're definitely going to deflation. Great. Then the Fed is about to turn the money printer on again. Now, if you argue, well, we're going to have a second wave of inflation. Yeah, that's possible. Then we're screwed in terms of like stagflation, right? Because then the economy sucks, jobs go to poops, and then you have inflation. But literally every time I ask somebody to show me where the inflation is, they can't do it. They're like, well, it's just my opinion. That's like the best response I get. You already know this. We do the stock market open live streams. Every day the market's open, with the exception of yesterday, 5:25 a.m. And I do my best to provide value every single day there, which is awesome. I hope you're there. But anyway, I ask people on a daily basis, please show me the inflation. It's not coming. So and we look in company earnings calls, obviously, more importantly, but it's pretty wild. Okay, so now that's out of the way. What else? What else is there to talk about? I mean, sure, we hope to see some more inventory in Q1 to Q2 here for real estate, but you know what I'm seeing? I'm seeing a lot of sellers that are like, we're not going to sell, we're just going to refinance, because they have like 7 or 8% interest rates, some of them. I don't think they're going to be able to pull off refinancing. So I think there are going to be a sweet ton of deals to get in real estate in Q1, Q2. We got a lot of good deals here in Q4. We think we absolutely crushed it with househack. Again, go to Househack Homes YouTube channel. I'll link it down below under the gold course pitch, which seriously, the gold course, it's worth your money. It's 100%. If you want a tax deduction going into 2024, and you just want the best from somebody who manages over $100 million, gold course. Link down below, right next to the link for the househack YouTube channel. Okay, but now we got to talk about stock picks. What about stock picks? Well, I wrote this on eHack, and I wanted to add a little bit more clarity on, here on YouTube. We can really talk about some of these things on YouTube a little bit better. So first, I still think chips are a play. Now look, at the end of 2022, we nailed it. We went crazy heavy on chips at the end of 22. We didn't know we were going to get the AI rush, which is wild. But I actually think 2024 will be the year of profit. In other words, companies having to prove that they're able to grow profit. So stocks we're watching for growing profits, well, are definitely not going to be the Nikes, the Best Buys, the Walmarts, the Targets, the Costcos. These are your staples and discretionaries. I don't actually think they're going to do well. I actually think those companies are more likely to advertise. Think about that for a moment. Companies that are missing sales targets advertise more to try to hit their sales targets. And so Trade Desk is a potential beneficiary of this so that they can show their investors growth again. So we still like Trade Desk. We also obviously still like TSMC, ASML, NVIDIA, AMD. Those are kind of generic. Intel, right? And so on. But also green energy and building if real estate continues to avoid a downturn, we're big fans of your Lowe's, your Home Depot, your Enphase, your Solar Edge. Basically, companies, Restoration Hardware, companies that would benefit likely or hopefully from new spending from homeowners again, whether they're refinancing or taking out debt through credit lines or whatever it is. I saw somebody left a comment. They're like, oh, Kevin thinks people are going to refinance their homes to take $30,000 of equity out just because they have some principal pay down over the last 3 years that they haven't used yet. Missing the point, man. You don't have to refinance your whole loan. You got to wake up to credit lines. America's built on debt. Credit lines are like literal credit cards. Delicious credit cards. Imagine going to a local credit union who is desperate for your business. And that credit union says, oh, looks like you got some equity in your home that you've built up over the few years. How would you like one of these? Right here. Let's get a little focus on it. How would you like one of these? A JP Morgan card, huh? Oh, you want one? How would you like it? Except it's for your house. So every time you go, you get to take money out of your house at an interest rate that's the fraction of a credit card. And depending on what you spend it on, is potentially a tax write-off. That got a little more tricky after actually the Trump tax cut plan of 2017. Debt now follows what you invested in, so not all the money you take out on a HELOC is a tax write-off anymore. But anyway, that is a huge potential source of spending. And what do those people spend money on when they get credit lines? Cars, boats, home improvements, solar. It's great. But the other thing that could be a big thing is honestly Apple's Q1 headset launch. That could either be inconsequential, so like a big nothing burger, or it might be the beginning of a significant new product line like the iPad. How many iPads did you have before 2010? 0, because it didn't exist yet. But frankly, I have so many of these darn things. It's wild. But the iPad is a wonder tool. Everybody has PDFs these days. If you don't have a good PDF reader yet, you're missing out. We actually talk about my workflow in the Gold course. Oh, there's a little dirt on it. I talk about my workflow in the Gold course about not only how I take notes, how I edit, how I research, how I keep it all organized, how I have like little bots that can kind of name things and title things for me. It's really kind of cool. This is a game changer. I love iPads. In fact, I have various different versions of them. I even have the tiny iPad right here. This is like the medium-sized iPad. This right here is the tiny one. This is really good for when you're going skiing and you want to take a break at the lodge. Child needs a little distraction or whatever, because it's light. Bro, you get one of those giant iPads, the iPad Pros, and then you put the little keyboard thingy on it. Try lugging that thing around in a backpack, man. It ain't gonna freaking work, man. It ain't gonna work. So anyway, the headset could be a game changer. Rivian, by the way, as I wrote here on eHack, Rivian, I also think bonds are going to keep rallying. But anyway, which is good for TMF, which I've been pitching for a while now. A lot of y'all made money on TMF. You want to say thank you? Buy the Gold course. Anyway, Rivian has survived hell. While still not making profitable cars, they could explode on vehicles turning profitable, which I think there is a chance Rivian goes profitable on vehicles in 2024. Game changer right there. That would be a game changer. On top of that, AI software sales will be heavily scrutinized. I don't think the SaaS revenue growth people are expecting from AI will be that great. But Palantir, I think, will be. No guarantees, obviously, but I regard Palantir as the only AI-focused company already profitable. And I think in 2024, they finally prove it mainstream. So those are just some examples. I've got plenty of other stock picks that we're talking about with course members and that, so stay tuned, buckle up. If you want to be part of those course member live streams, when we do analysis together, Gold course, it's not just the lectures you get. You want to learn about taxes or being an entrepreneur or efficiency or whatever, and you want a tax write-off by the end of the year? Gold course. You want access to all the live streams? Gold course. But anyway, jobs. That's the biggest concern I have for next year. I'm just looking at my notes here. Biggest concern for next year, it's jobs. So we'll see what happens, but I'm cautiously optimistic. Really appreciate you being here. I'll keep bringing updates to you, and I'm going to finish getting some really good foundations set for 2024. I personally, it's just a personal note, am extremely excited because I got tests behind me, I got foundation building behind me, I got physical infrastructure set up behind me, you know, whether it's offices or studio upgrades, transportation up, or whatever. All these things are set, and now it's just work. And I'm so excited. And if you know somebody or want to recommend somebody for an interview on the channel, send them over to me on Twitter at Real Meat Kevin. Thanks so much. We'll see you in the next one. Bye.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate an actively managed ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than househack, nor am I presently acting as a market maker.